I think I'm going to just flip the page a little bit because I want to know about bonds. But with the share buyback, you know, the Golden Dragon Index was lower in the U.S. today. It got weaker yesterday after the PBOC didn't cut the LPR. So central bank mixed in there. You know, it ended the day a bit lower. I'm just curious in terms of starting there, you know, the Chinese bond market's been looking good. They haven't cut the LPR. They've promised to do more stimulus. When you look at this Alibaba move, what do you make of Chinese tech stocks and Chinese equities more broadly?
Well, we think in the general that the Chinese tech sector is actually clearly bottomed out because of the fact that, you know, last week's comments from the central government that, you know, that they are more or less towards the tail end of the regulatory oversight of the Chinese tech companies. And on top of that, we do expect more credit easing to come towards the middle of this year, not so early, because of the fact that it was actually only in January that they actually started to cut the MLF rates, the LPR rates, and of course the triple R rate as well. So we do expect more easing to come, and we also do expect a lot more fiscal measures to actually come through to stimulate the economy.
So good for you, Chinese equities then. And another guest said he didn't think they'd meet the 5.5% GDP target, but they'd have enough growth to, over the course of the year, investors to realize that equities in China are potentially a good investment.
Yeah, I mean, if you look at the valuations of the Chinese equities market, if you look at the MSCI China shares, they're actually trading at very, very attractive valuations at about 12.5 times earnings. And we do expect earnings growth this year to come in anywhere between 14 to 18%. So based on the valuations and the earnings growth, they are cheap. They are trading at about a 35% discount from US equity markets. And on top of that, you have policymakers that are now starting to actually open up and ease credit into the economy. But we do expect the economy to be, the growth to be very back-loaded in the sense that it's only in the second half that we do expect a pretty strong recovery, whereas in the first half we do expect growth to be quite moribund in that sense.
So we've seen volatility pull back when it comes to equities a little bit at this point, but when you take a look at the big moves across bond markets, is it just a matter of time that we see that start to seep through as well?
Yeah, I think you're right. I think it's the bonds market or the rates market that's actually driving the global capital markets right now. And any form of volatility in the rates market is likely to translate into volatility in the other asset classes. Last night's move on the rates market was certainly a very, very steep one. And it came across because of the fact that, you know, Fed Chair Powell was trying to prep the markets for a possible 50 basis points hike at the next policy meeting. If that comes true, then I think the markets are likely to be in for a pretty rough ride because of the fact that your 10-year yields are now at 2.3%. And there was a significant jump in the 2 years as well. And your whole curve has really, really flattened out.
Where do you find opportunities at the moment, particularly when it comes to interesting valuations?
Okay, we actually liked the energy shares, and when the energy prices actually came up, especially for Brent, to about $100 per barrel just last week, we felt that it was actually a very, very good opportunity to get in because we do see commodities as a very good hedge for inflation, for rates actually rising, given the fact that, you know, the global supply chain concerns, the commodities shortages in many parts of the world will likely mean that inflation remains pretty high. So one way of countering that is basically to get exposed to the commodity sector. So that's one area we like. We also like Chinese stocks because, as we've mentioned before, we do think that the Chinese stocks are very attractive. Investors are still typically bearish about the Chinese equities market, and policymakers are stimulated. Therefore, if you combine all that together on a holistic basis, Chinese stocks actually look really, really attractive.
More broadly, Kelvin, when you look at the Ukraine war, when you look at how it has spurred this big increase in oil prices, which may not be over, when you look at what it's done to food prices, and that is going to just reverberate through so many economies, so many markets, and certainly in Asia, and it's going to be a big deal for exporters as well. How does that affect your investment picture of where you say, I'm going to put money this year or not?
Yeah. I think that's a very good question. And, you know, we struggle with it as well, because I think if you have a scenario where, you know, inflation is actually rising across all countries, then I think the very first point of view is basically your currencies. If you have a higher base of starting for your inflation, that basically means that countries are not likely to actually tolerate a weaker currency. Not like in the past cycles where inflation was not really a concern. So if the dollar strengthens because of rate hike, most countries are okay with their currencies being weaker because that basically means better exports. But in this case here, you got to temper that enthusiasm because of the fact that if your currency is weak, then your input prices are likely to rise particularly strongly, especially for the Asian countries, which are pretty much net importers of commodities. So I think from that standpoint, most Asian countries are likely to actually are unlikely to tolerate a weaker currency and basically have the currencies start off at a higher base against the US dollar. With that in mind, I do think that the countries where you have lower debt levels, where you have current account surpluses, are likely to be in a better position than countries with the opposite fundamentals. And for that measure, we do think that countries with lower debt levels will be a better form of investment for Asia at this point in time. And that means countries like Singapore, China to a large extent. These are actually markets that we think will likely stand better over the next 6 months.